A couple of people, we started this journey together. 90% of them have given up. 90%. Yes, I'm even saying 90%, almost 95. Close people I knew that we say, okay, we want to learn how to trade, but they are nowhere to be found now. In short, some of them I say, oh, I'll come and meet you, you teach me. And I just tell them jokingly, but it's the truth. I tell them you have to pay for it. Because when we had the opportunity, you didn't take it serious. You're waiting to see evidence first before you take it serious. But so please, let's not, for as many of us that are joining in on this call, please, let's take advantage of these opportunities. I can tell you, I started, maybe some of you were not in the introductory class. I started out saying that what I'm teaching out is what if you tell me to value based on the money I've paid in tuition in the market and the money I've paid to mentors and the money I've paid to source materials, this what I'm giving now is something I spent over $2,000 to acquire this knowledge based on paying mentors, the experience, late nights, sleepless nights, searching countless of YouTube, watching thousands of hours of videos, trying to back testing, trying to make things work. So please, if you are tempted, please take it serious, right? But I know it's a human mentality. For if you're not paying money for something, you tend to just kind of like you are not serious with it and you take it for granted. Please, let's just try, because what I'm putting out, there's nothing different from if you see all those mentorship we are seeing, they are charging 300K, they are charging $500, $300. There's nothing they are going to teach you different from what I'm putting out here free of charge, right? Okay, let's jump straight into the video. I never understood why ICT used to rant, but I find myself doing the same thing. Okay, so let's jump straight into the video for today. The lesson for today, sorry. So today we're looking at institutional reference point. Institutional reference point, right? So we call them institutional reference point because they are the areas where institutions are looking to take their trades, right? Where the major, some people call them the market makers, right? Some people call them the big players. Some people call them the hedge fund guys, the mutual funds guys, the big investments company that are into trading. This is where they look because they have over a period of time understood how the algorithm is programmed, right? So they understand that the algorithm is programmed such a way that there's particular reference points that price will always come to, and the reactions from those points are high because most of those institutions take advantage of those points, right? I'm going to issue a disclaimer. I'm not going to be teaching you so in depth, right? Because it can be confusing. Trading is one of the things that can be very confusing when you have several concepts and you now begin to battle with how you are going to make them work, right? So I'm just going to give you like a brief intro. That's why I say this class is going to be part A and part B. I'm going to give you a brief introduction on this reference point, but we are going to focus particularly on two of them because I promised that I was going to teach you exactly how I look at the market. I'm going to teach you what was going to work for you, what you're going to take and start trading and start making profit, just like I'm making profits out of the market right now. Right? So I'll be focusing more on the breaker block, the fair value gap. Those are the two. Yes, I will just do a brief introduction on all of them, right? So if you want to research, you can go and do, but if you want to go and keep researching and keep struggling to find a way to integrate them, but I'm going to teach you exactly how I integrate them. So I'll focus on breaker blocks and on fair value gaps. That's basically what I use to trade, right? I know all of them. I see them. I can recognize them on the chart, but my focus is on breaker block and on fair value gaps, right? So I trade specifically a variant of the fair value gap, which I'm going to teach us in this class as we proceed in the subsequent classes, right? So first of all, the mitigation block, right? mitigation block, right? I don't know if I was right, but I was trying to find out how in order of importance, but don't not the way I put them, don't mind. I think it's kind of like that in order to which of importance, but I might have missed for the people that have an idea. I might have missed it, but don't just discount it. Don't worry about that. Just take the concept and the ones I'm going to teach today in the class. So first we'll go into mitigation block, right? First, I'm going to give an illustration here. Then we'll go into the chart and we'll look at all of them briefly. Then the part two of this class will be going deep into how I integrate the breaker block, how you can use the breaker block as a means for your higher time frame analysis, how you can use the fair value gap as a means for your higher time frame analysis, and I'll go into the inversion fair value gaps. That's another variant of the fair value gap. So mitigation block, right? So I'm going to give you example, right? So this is price. So that's for the, let's look at the bearish scenario. Uh,
Sorry, please, can he be heard? Because I can't hear anything. Okay, he's not in.
These guys, you guys should just wait. James is having network. It will come up. It will come back up on next.
Hello guys, can you hear me? Hello, can you guys hear me?
Yes, sir, we can hear you.
Sorry, I lost connection. I had to switch to an alternate network. These things kind of happen sometimes. So we just get, can you, if you can see my screen, just confirm so we just continue.
Yes, I can see your screen.
Okay. So Emmanuel, you're raising your hand. Also, is it also Emmanuel? You're raising your hand. You want to ask a question? Can just unmute your mic and go. Okay. So let's get back to the class. So now, if you can see my screen, okay. So you find out a low was created, particular low was created in the market, right? And price comes down, but it doesn't go below that low, right? Then it takes out the high, right? So in this high here, we're going to understand that there is a block of price that, so in this particular place, this is what you have. There's a particular, what you call, I'm going to explain it here, we call an order block, but let me start, right? So you find that there was an order block. Don't mind my drawing, I'm just using that free tool, right? So this is there's a bullish candle, then there's a bearish candle. There's an order block at this particular point that induced the impulse to the down, to this downside, right? So price goes higher, right? It now comes down to respect. This order block here serves as a means of, for the purpose of this class, for it as a means of support, right? To support price, to prevent price from going below. So price now shoots up from here, right? Why is this? It's a reference point because the big players will be looking at placing. There are some few orders here that were placed here in the order book that price has to come back to peak before continuing in the direction of price, right? Now, if you merge the concept of liquidity we learned in the previous class, and you see that there will be people that will be in this move along this line, right? Before here, some people that will be late buyers here thinking that we are already going up, that they will serve as liquidity to take down to this particular order block or a particular impulse that started here down, right? So this same thing applies for the bearish movement, right? There was a high, a previous high that price will respect and refuse to go above, right? So now there was a particular, I'll explain other blocks. So just when we get to that point, you understand. There's a particular order block in this place that serves as a means to push impulse price to this place, to this particular point, but price didn't break this high here, right? So as soon as price comes and breaks this level, this place now serves as the next place to resist price from penetrating and serves as a place to support price for price to move down, right? So we say the mitigation block is there. That's what is called a mitigation block, right? That's what it's called a mitigation block. Now, the next thing I'm going to show is the breaker block, right? So when I explain the breaker block, you discover the difference between the mitigation block and the breaker block, right? So follow me. Now, for the breaker block, you find out that instead of the low will be taken out, right? The low will be taken out. This particular low will be taken out before the high is now taken out again. Then same principle applies for the breaker block. Now, the difference between the breaker block and the mitigation block is that the breaker block most likely will be formed here. Yes, I hope I'm getting this right. Okay, right? So there will be there's an order block that, okay, sorry, I bad. This is not, sorry, I'm missing the concept. Don't worry. Okay, now the breaker block now is that the difference between the mitigation block and the breaker block is the low being taken out. As simpler to understand. This low that is taken out, right? So the same concept applies. So there's an order block here that once it's violated, it serves as support for bullish movement, for price to go up. So the difference between the mitigation block and the breaker block is in that low, first of all, being taken out. That low that formed the impulse to the place where an order block imposed price to the downside. That's the difference. The low will be taken out before the other block that was here that formed this impulse will be taken out. When we go into the chart and we explain, I think it's simpler for you to understand when I give you explanation. So let's say, let me just do this quickly. Now, if you remember in our previous class, I talked about engulfing candles, right? The first class, right? So now this will be sorry, this will be the pattern, right? So an order block is just like an engulfing candle formation, but the difference is in that the order block takes out a short-term level, either takes out a short-term low or takes out a short-term high with an impulse, right? So you see this thing is formed. This is what will be formed. This is what will be formed. Sorry. This is what will be formed around this point here, right? So like an engulfing that impulse price to the downside to take out this low. So when price comes back and breaks this, we call it the order block, the bearish order block. When we go, we'll see. When price breaks its high, it now turns into what? A breaker block, right? Like I said, the difference between the breaker block and the mitigation block is in the low being taken out. For the mitigation block, the low is not taken out. Is the pattern is like this, but for the breaker block, the low is taken out. Do you understand? So there are two types of mitigation block, and there are two types of breaker block you can find. We have the bearish mitigation block, and we have the bullish mitigation block. Now, from what I said, you understand that bearish means when price is going down, right? When price is going down, then bullish means when price is going up. So we have the bearish mitigation block, and we have the bullish mitigation block. We also have the bearish breaker, and we have the bullish breaker block, right? So for the purpose of this class, I might just call them breaker, I can just call them mitigation, right? So the same thing applies for the sell scenario, right? For the bearish breaker block here. So the high has to be taken. That high that imposed to the downside has to be taken first before price comes and take out a bullish order block. So for the case of the bearish movement, this will be like the order block. The best way to understand it is like it's like an engulfing. So there was this price pattern that imposed price to the upside. It imposed price to the upside here. So something around here. So once this order block is violated, it now turns into a breaker block. So it will now serve as, so what people that trade support and resistance, you say it was once support turned resistance. Yes, if you're in retail before, if that will help you understand it better. That's what you have. So other people call them flip zones too, right? So the place was holding as a support in our turn. So basically, this is the concept of the mitigation block and the breaker block, right? So we are going to go to the charts. I will explain this. I'll show you how they form in the marketplace. I'll show you the mitigation block. I'll show you the mitigation block. I'll show you the breaker. Or let's look for ideal scenarios. Oh, let's go. Something ideal. I know it's as you trade. Okay. Can we say here? No. Oh, sorry. Okay. Let's look at let me go to 15 minutes time frame. Sorry. This is let's trying to find great examples. Like my eyes are not catching. Let's see. Okay. No. It's not ideal for our class, so you don't get confused. I'm looking for an ideal situation. By the time you gain experience, you now begin to understand it better. What's happening? Okay. I think I can find something here. Okay. No. This is not ideal. Oh, what's up? Let's see. Sorry. Okay, if I see, I was looking for, I'm looking for mitigation first, but I think we can find, this move. I think this is it. But the low was taken first when took out this high. Okay, this can serve as, no, I don't like this. I don't like that. I don't like that one. Let's look at something. Let's look at something. What's happening? And I saw this today. Which assets? For some good example. Okay, yeah, I've seen one. Okay, now we can see this price formation here, right? So this was a high, right? That price came from, right? Came from here. It didn't break this particular high. It came down. Price now came to this point before going down. So now for this case, if you understand my diagram, I just drew it so that you understand the concept the same way I drew it, right? So if I move it away, you see now if you look at price here, you will discover that this was the high that was not taken out, right? Price came here, didn't take out the high, right? So in this particular case, if you look at this place here, the last bearish, the last down close candle before this impulse that came up here but didn't take out this particular high, then it was broken through. Now you see this point. This was like, if you go to the lower time frame, you see that it took out its two short-term levels, right? So this merges as like a mitigation block. Now, do you notice that when price closed below it, it came back to retest that place? It didn't go above this block. You see where I marked with let's just, because let's use that. See where I marked with this red color, right? So price didn't break above this point, right? So price went upward. It went upward, but it did not take the high. It didn't take this high here. It came down and broke the block, right? This is like a bullish order block because it took out multiple short-term levels. If we go to a lower time frame, you see it's clearly, but just understand that. So it took out this particular block, the last down close candle before the bullish impulse. You see, we have an impulse of 3 bullish candles, right? 1, 2, and 3. That impulse up. So when that block was taken out, when this bearish candle, that bearish candle, now that's the mitigation block. That bearish candle, when it was taken out, it now turned resistance. That price didn't go above it. Now this is where institutions will come in to enter them. So they're looking to sell in this move, because we see if you combine market structure, you see that price was going in a downtrend and there was a break of structure when it took out this mitigation block. So price will go back to that mitigation block to retest before it continues, right? Mm-hmm. Do we understand that? That's an example of a mitigation block. Let me look for another example. If I see a breaker, we'll stop. Okay. We have an example here too. Can you guys hear me? Am I see live? So we have, you see this low, this particular low, right? Price came, it didn't take out the low and it broke out this impulse, right? So now we'll mark this last bullish candle. Now this is for the bullish breaker, right? The first example I showed was for the bearish breaker, right? So this bullish candle, the last up close candle before the impulsive move downwards, serves as our mitigation block. So once price broke above it, can you see when price came down, it served as support. It didn't go below it, and price used that as support to continue to the upside by going up. Do we understand? Can you guys hear me? I hope my network has not gone off. Am I still on the call?
Yes, sir.
Okay, so that is the case of the mitigation block, right? So I'm going to give another example. Okay, let's give an example of a breaker, right? So I said the difference between the breaker block and the mitigation block is that a low was taken, right? So I've seen an example of a breaker block here, right? So now First of all, right, price went from here, right, from here to this high, right? Then it came down and broke this low, right? When it broke the low, now what induced the break of that low? That's the first thing you have to ask yourself. What was the impulse that took us down to break that low? Yeah, there was an order block, the last up close bullish candle. You mark that out. That last candle, right? If you mark it out, that candle caused the impulse that took out the particular low, this low here, right? Now, when price goes back up to break that candle and close above it, that candle now turns into what, for this scenario, is a bullish breaker, right? It serves as support to move price upward. And you can see the way price respected the zone to continue the movement to the upside, right? So we call this the bullish breaker, right? Then let's look for an example of a bearish breaker for bearish movement. Uh, okay. Let's look. No. Sorry, sometimes. Okay, I'm seeing another bullish breaker again, but let's go. I need to show you a bearish example. Okay, let's go down here. Okay, that's bullish, bearish scenario. Let's see. Oh, so if you notice, the concept of the breaker is it works based on the concept of liquidity, right? So liquidity has to be taken out. Okay, this example is not so perfect, but I think we can make do with this one. You understand, right? Now this was a high that took us to this low, right? So price, this was the high, right? Price took out this high by this move, this bullish move up, right? That's the first thing. Now, this is also like liquidity purging, right? So the concept of breaker is also like liquidity purging. So price takes out liquidity. All the early people that were early sellers took them out. It came down. Now, what you ask yourself, what was the order block that caused the impulse? Now, the order block, I'm already explaining order block. So the order block is the last bearish candle, right? The last down close candle before a bullish impulse, right? When you have multiple bullish candle to the upside that takes out more short-term level, right? So we can call this now for the short-term level. A short-term level is anytime when you see a bearish and a bullish movement, then that level becomes a short-term level. Now, in this case, we call it a short-term high, right? This is a short-term high. This level 2 is a short-term high. So this order block here, right, was what induced the movement, this impulse to the upside that took out this high, took out multiple short-term levels, short-term high, and took out this high, right? Now, once price comes below and close below that candle now becomes a valid what breaker. Now a mentor of mine will always say, ICT, I know some of you know him, he will always say that you pay attention to the candle, not the wick. The wick, they just do the damage, right? So as long as the candle does not close above this, you see how it respected. So all this wick here is just to go above to seek out more liquidity to run out. But you see, it was respected. No candle closed above this the breaker, no candle close, and you see price respected it to continue the movement downwards, right? So we have explained the breaker. So since we are already in the chart, I will just briefly explain the concept of liquidity void, right? Liquidity void. Now, liquidity void basically is a scenario where there is one side price delivery. When price delivers on one side, multiple one side. So what the easiest way to understand liquidity, right, is liquidity void is to say when you have multiple fair value gaps, right? I explained fair value gap briefly in the last class. I'm going to explain in details, right? So liquidity void means that there's a void, there's a gap in price. So there's one-sided delivery, and price, like I told you, that price will always seek to balance. When there's one-sided delivery, price will always seek to come back to balance that level of price delivery, because it's an inefficiency and price must balance it. It can balance it immediately, it can balance it in a particular time in future. It depends, right? So when there's one-sided price delivery, price will always come down to seek it to balance that area, right? I'm looking for a good example for us. I'm seeing some example here, but I'm looking for a good example to explain liquidity void. Yes, this is like an example, although price went high, like you see, this was a one-sided price delivery. You see from this whole place, right? So it's a one-sided price delivery. You see, price just keep tanking, keep going down with bearish candles. So it's one-sided. So price has to come down. If you see places like this in the market, you know that price must come back. Even if price is bearish, price must come to balance this void before continuing in the motion. See another example here, right? This was one-sided price delivery here, right? You see one-sided price delivery, right? You see multiple 1, 2, 3, 4, 5 bullish movement without any bearish candle. Do you see that price came down to balance it before continuing upward? And you see, this is the balancing. This point is the rebalancing, is the feeling of this inefficiency. So liquidity void and fair value gap are a form of imbalance, or what we call inefficiency in the marketplace, right? So price came down to balance all this void to move, because price must move efficiently. Price must move efficiently in the market, right? That is liquidity void in explanation, right? So after this class, it's your assignment now. You can go over the video and go back and look for examples like this. You see price came, balance it and move. Let me see if I'll see another void again. See this another one-sided delivery. This another one-sided delivery to the downside. Can you see? This is a void, one-sided delivery. Can you see the way price came here to balance it? Came to balance. Most times price will always come to 50% of the void, 50% or more to balance the void. That's to fill out the inefficiency, right? You see this movement here, filled out, came to tap at least this from this candle this week to fill out the inefficiency in the market before price continued the delivery downwards, right? So you see these voids, they are everywhere in the market. Yes, this and that void, right? You see at a later time, even if you are bearish, price will need to balance this. This is a liquidity void, right? Because there were orders, price moved aggressive, maybe news caused it as an impulse. So there are orders, maybe sellers, orders that were placed in the order book that price will need to come and pick and trigger all those orders to balance the efficient movement of price, the way the algo is designed. So price in a later date will fill out void. So this is a liquidity void, right? So the third, let's go back to, let's see, where were we? Okay, now, so I've explained. So let me just pause here and be sure we are following. I've explained mitigation block, I've explained breaker block, I've explained liquidity void, right? Are you guys with me? Hello?
Sir.
Yes.
Okay, so I've explained those ones, right? So the concept, let me just brush through and we'll call it a day trade. Let me just brush through fair value gap, order block, and old high and old low, right? So I'll just brush through them. So I'll have to do a diagram to explain fair value gap, right? Let me just make it a bit, because I always get feedback from class when after the class, so that we understand it better. Now, please permit, drawing will not be perfect because I'm drawing it on the go, right? So this is the week up. This is the down week, right? So let's duplicate this candle. Okay, let me explain the upward movement, right? So then let's see, candle 1, candle 2, and candle 3, right? So now let me tag them. This is candle 1, this is candle 2, and this is candle 3. So I'm explaining fair value gap. Now, so can we delete this? Can we delete this price, these things? I think one still them, okay. So now, when we, okay, I think let me not confuse you. I want you to understand something first of all before, let's just imagine, let me just paint these candles gray. Let's do it gray. So if you are seeing green and red, you might get confused. When I start explaining, you might get confused with my explanation on why I'm explaining that. Okay, so let's just color the candles gray. That's to tell you that really it doesn't matter the type of candle, whether it's a bullish candle or it's a bearish candle. Fair value gap are 3 candle price formation pattern, whereby the high, there's a gap between the high of the first candle. I'm explaining for bullish movement now. The high of the first candle and the low of the last candle. Now, what is high and what is low? This is our high. Remember when we explained our beginner class now, this is the high now, the candle wick, that is the high, the candle wick, right? So let me draw it to this side so you understand, right? Can you see this is the candle wick? That's the high of the first candle and the low of the third candle, right? Because there must be a balancing in price movement. Now, this gap here, in simple balance, this gap is what is called, delete this, is what is called fair value gap. This is what is called fair value gap in the marketplace, right? When there's an inefficiency that you can also call it an imbalance. And also, why is it called fair value gap? Let me explain. Because price was moved so rapidly like this, although price is bullish, price moves so rapidly, you can see by 3 consecutive candles that are close to the upside. So this could have been a bearish candle that started here before a bullish candle. It doesn't matter. But this movement caused an inefficiency in the market, right? So now, if for buyers and sellers, okay, let me explain it this way. When buyers want to buy and sellers want to sell, as a buyer, where are you seeking to buy? You are seeking to buy low, right? In normal business, when you buy in the low price, you want to sell at a higher price, right? Do we get that concept? So you are buying low and you are selling at a higher price, right? And sellers want to sell at a higher price, right? So there's a mismatch in the marketplace, right? So the algo must come down because there's a mismatch of orders, right? There's a mismatch between the sell orders and the buy orders. So it must come down to deliver a fair price. So this fair price now, this gap now is a fair price for both the sellers and the buyers, right? So the person that is wanted to buy is not buying too high at this point, right? The person is not buying too high at this particular point up here. It's not buying too high at this point up here. It's not buying at this candle, so it's high. And the seller too is not selling too low at this candle here. So there's a middle point, like a midpoint where the buyers and seller will meet. That's why it's called the fair value gap. So it's an area of fair value for both buyers and sellers in the marketplace. Do we understand? So that's the fair value gap. So now the next, I'll go to the chart now. Already I explained a bit about order block, right? So order block is the last down close. For bullish order block, we have two types, right? So fair value gaps too, there are two types. There's a bullish one, there's a bearish. Now every institutional reference point, you should just understand there are two types. There's bullish, there's bearish, like I showed you in the chart. So if we go into the chart right now, we will see, let's just even go to, I think with this, because in the next class, we'll be focusing more on the fair value gaps and the breaker blocks, right? So we'll now explain the concept better for us to understand. So let me just show you in the chart, simple way for you to spot fair value gap, right? In the chart, right? So when price, now let's look at this point, for instance, sorry. Let's magnify this price delivery. Okay, I saw something, I missed it. Okay, looking for, so it doesn't matter on the time frame that the gap is. Okay, this is a very good example of fair value gap, right? So we can see now I say that fair value gap is a 3-candle price formation, right? It's a 3-candle price formation, right? So let's tag our candle now. This is 1. Are you guys following? Can I just hear you? Just say something. Let me just know you're following.
Yes, sir.
Okay.
Yes.
This candle
Yes,
1.
sir.
Okay. So this is candle 2. Now candle 2 is always called the gap candle. It's called the gap candle, right? That's where the gap is. You find the gap because there's a gap between candle 1 and candle 3. Candle 2, right? So now this other one now will now be this one here. Can you see it? Let me put it this side so we see it well. And that's our candle 3. Can we see it? So now you see price delivery, right? So there was an impulse here. In this case, we have multiple. So, but I'm just showing the last one that price reacted from, right? When we get in time, you understand why price reacted on the second one, because there's one here. You can see this is candle 1 here, this is candle 2 here, and this is candle 3 too, right? But I'm explaining the second gap, so understand. So it created a gap in the marketplace, right? It created a gap here. So this gap candle, this candle 2 is always called the gap candle, right? So it created a gap here. You see a gap between the high. Remember I told you the high of the first candle and the low of the third candle 3. Can we see it? Can you see how price came to fill that gap neatly before continuing to the upside, right? Now, fair value gaps are so powerful on your charts that they kind of like tell you, they give you a clue the direction of where market is going to. So if we are closing above fair value gap, it tells you that market is going bullish. As long as price keep closing and respecting above fair value, it tells you that market is going bullish. So even you can trade on a 1-minute time frame, you can scalp using the fair value gap. If you understand your market structure and you understand the fair value gap, you can use it to scalp and get entries in the marketplace, because price is fractal. Everything happening on 1 minute is happening on 2 minutes, happening on 3, 4, 5, down to 1 hour. The video is already long. I try, but unfortunately, so we'll end here. So you see price came to this gap and now price respected it and continued. So this is a fair value gap, right? So I'll just go now, or I'll not tag the candles. I'll just explain the bearish scenario for fair value gap, right? I'll explain the bearish scenario of fair value gap. Let's go quickly down here. Let me look for an ID environment. So your assignment, okay, let me say the assignment. Your assignment now is to go out, right? Do this assignment, because this is eye training. You train yourself. Once you train yourself to see these things, you cannot unsee them. You'll just be seeing them, right? So you see this point here now. I just went to mark it briefly. Now I see this is called this candle 1. This is bearish candle 1. This is candle 2, and this is candle 3, right? Right now you see the gap between. Now for bearish movement, the rule would be the gap between the low of candle 1 and the high of candle 3. That gap is what is called fair value gap. Right? Can you see? Right? So can you see the way price respected that point, right? Now, sometimes like there can be a, like ICT calls this a mohawk. Price can go and just like play above it, but still come down and close below it, right? And also one thing you should note that the midpoint of the fair value gap is called consequent encroachment. It's called CE, consequent encroachment, right? So that midpoint always serves as a guide to know what price is doing. As long as price comes within that gap and price always closes below that gap, you see, maybe like for this case now, you see there's one candle that went, but it didn't go above it. It came back. The next candle now closed above it with an impulse. You see, with an engulfing candle, right? That will tell you that this fair value gap is most likely to be respected. And you see price respected it close below the whole fair value gap. So with that, I think let's give time for questions. We have come to the end. Next class, we're going to do part 2 of institutional reference points, but we're going to be focusing more on the fair value gap and the breaker. Why? Because that is my model. That is what I use mostly to trade. So I promise you to teach you my model. I don't just want to teach you theories, but I want to teach you exactly how I apply them in the marketplace, right? Where were we? I can't even find the particular place. Or where did we delete? Okay. So now can we ask our question? I think the hand is raised. Can you unmute and ask your question? Let's just take 5 minutes to ask questions.
Okay. Good evening. Well done once
Yeah,
again.
good evening.
My question is, for the fair value gaps, right?
Yes.
Must the 3 candles be of the same color? Like, must they all be that either bearish or must they all be bullish to decide, okay, the high and the low of the first and the third candle? That's
Okay,
my first question.
you
Yes.
remember when I was explaining, I told you that I will have to color all these candles gray, right? So that you
Okay.
don't see um bullish candle green or red, because the most common colors of candle is green and red. Green for
Yeah.
upward candles and red for downward candle. So I
Yes.
said I'm not going to color them any of those colors to make you understand that it does not matter.
Okay.
It does not matter. But now this is the caveat. This is the exception. Now, when we look into fair value gap in our next class, there's what we call high probability fair value gaps.
Okay.
Yeah, so high probability fair value gaps are those fair value gaps that form exactly with the same candles. So if you are seeking for higher price and you see fair value gaps that form with 3 bullish candles, it's a high probability fair value gap.
Okay.
Yes. Now that does not mean that price will not respect the other ones, but that one is high
High
probability.
probability.
Yes, it's high probability. So that's the difference between the coloring. Yeah.
Okay. All right. I understand that.
Yes.
Then just a quick one, the second question. In regards to the mitigation breaker, though my the sharing was not showing, but I was sharing you. In regards to the mitigation breaker and the
Mitigation block and breaker block.
yes, the mitigation break blocker and other block. Does like in my, when you explain it, does it mean that the mitigation blocker is usually like the lower high that is later taken out, while the other block is the lower low that is first taken out before the that one is taken out? I don't know if I'm confusing myself.
Okay. So let me explain it. It's mitigation block and breaker block, right?
Okay,
So
mitigation block.
for the mitigation block, the
Yes.
higher low or whatever direction, if you are in a bearish direction, the lower high is not
Yes.
taken out. It's maintained, it's respected for the
Okay.
mitigation block. But for the breaker block, the higher low or the lower high is taken out So that's just the difference between the breaker block, right? So now let me just briefly just understand it with this diagram. I hope I'm just trying not to take time, but okay, I think let me stop the recording from this question. So the questions are just let not be in the recording. Let's just ask the question so the recording is not too long, right?
Okay.